A client called me up recently and told me she made $900,000 in OnlyFans income in 2025, and that she will probably make at least 1.1 million in 2026. She wanted tax saving advice. Now, when someone is making that kind of money, you'd expect to see a sophisticated tax strategy already in place. But when I reviewed her tax return, I found 3 surprisingly simple mistakes that had likely been costing her tens of thousands of dollars every single year. The crazy part? These weren't advanced strategies she was missing out on. These were basic planning opportunities she had completely missed for years. Mistake number 1, she needed an S corp. She reported all of her income on a Schedule C as a sole proprietor. She should have had an S corp years ago. The standard advice is that an S corp might save you taxes once you make roughly $50,000 plus in profit. It probably becomes worth it for most people closer to about $80,000 plus, and possibly even more depending on the state you live in and what exactly it is that you do. The main opportunity with an S corp is to save on self-employment taxes. By reporting all $900,000 of her income on a Schedule C, every single dollar was exposed to Medicare and higher earner surtaxes. With an S corp, we could have set her up with a reasonable salary of, let's say, $200,000. That would have allowed roughly $700,000 of profit to avoid that additional 3.8% Medicare tax. That one change alone could have saved her over $26,000 per year. Now keep that number in mind because we're just getting started. Number 2, the retirement black hole. She had not invested a single dollar in retirement accounts. She was single and deep into the highest 37% federal tax bracket. At her income level, she could have been making tax-deductible contributions into a solo 401k of $60,000 to $70,000 per year. In her tax bracket, that would have saved her $20,000 to $30,000 a year in taxes, and it would have given her the opportunity to let those funds grow tax deferred for the next few decades. But what surprised me even more wasn't the lack of retirement contributions. It was what she was doing with the rest of her money, which brings us to mistake number 3. The CD trap is what I'm going to call it. She had $1 million sitting in certificates of deposit. That was pretty much all of her money and her entire net worth. Because of that, she reported almost $50,000 of interest income on her tax return. And because she's in the highest tax bracket, she had to pay about $20,000 of that back to the IRS. And here's the kicker. She had no immediate plans to use that $1 million for anything. There are roughly 0 financial advisors who would tell you to put all of your money in CDs unless you plan to spend it in the next 1 to 3 years. She was letting inflation eat her cash while the IRS took half the interest. The lesson here isn't really about OnlyFans. It's about what happens when income grows faster than strategy. What worked when you were making $80,000 a year can be incredibly expensive when you're making $800,000 or $1 million a year. The tax code rewards people who plan ahead. It punishes people who stay on autopilot. At a certain income level, tax planning stops being optional and becomes part of the business itself. You cannot treat a 7-figure business like a side hustle. It requires proactive planning, smart asset placement, and working with an advisor like me who can see the bigger picture before mistakes become expensive. If you are a high earner or a content creator clearing 6 or 7 figures, stop letting a basic tax return drain your wealth. Click the link below to book a free consult with me. Let's look at your returns and see what you're leaving on the table. Thank you for watching. Don't just file your taxes, plan them.